Unlocking Value, The Timeless Wisdom of Benjamin Graham. Foundations of Value. Benjamin Graham was born in 1894 in London into a family of modest means, yet he grew up with a curiosity that would later shape the world of investing. As a young man, he studied law, but he soon found his passion in numbers and the markets. He left England for the United States, where he studied economics and joined the New York Stock Exchange as a trader. There he experienced the volatility of the 1929 crash, a pivotal moment that would refine his thinking about security, risk, and the importance of a disciplined approach. He later served for a short period in the U.S. Army during World War I, gaining a sense of how external forces can impact markets. In the 1930s, Graham joined the investment partnership that would become Graham-Newman, a firm still known today for its disciplined investment style. He taught at Columbia University. It was there that he met a young William Buffett. Buffett walked into Graham's lecture room for the first time with the intention of investing a single dollar, and after listening to Graham's lesson on intrinsic value, walked out with a philosophy that would guide him for 50 years. A quote that captures Graham's ethos is, "The investor's chief problem is to achieve an adequate return with a sensible level of risk." His message is simple yet powerful. Success does not come from daring speculation, but from a methodical, risk-conscious process. This lesson is as relevant to a student earning a living wage as it is to a seasoned investor. To apply Graham's foundational insight today, create a safety cushion in your finances. Set aside at least 3 to 6 months of living expenses in a liquid savings account. Then, when you decide to explore investments, target opportunities that are priced below their calculated intrinsic value. A concrete way to do this is using a spreadsheet to compare a company's projected cash flows with its current market price. If you spot a gap, that is your margin of safety. Key takeaway: Graham showed us that disciplined, risk-averse thinking has survived the most extreme market turns. By carving out a financial safety net and looking for investments with a clear value gap, you can emulate the calm and steady approach that made Graham a pioneer. How prepared are you to establish your own safety cushion and look for value in your next investment decision? The Graham Blueprint, 5 pillars of value. Benjamin Graham's philosophy can be distilled into 5 core principles that form a robust framework for investors. The first pillar is the margin of safety. Graham famously said, "It is safe enough to be certain of making a gain on a few of them, and the rest will be a loss." He insisted that you should never pay more than a fraction of a company's intrinsic value. A story illustrates this. In the early 1940s, Graham bought shares of a struggling textiles company for just 1/10 of its net asset value because he saw a real opportunity for turnaround. He held onto the investment through years of hardship, and eventually the company returned to profitability, delivering a reward that far exceeded the purchase price. The second pillar involves calculating intrinsic value. Graham taught that a firm's true worth is the present value of its future earnings, adjusted for risk. To find intrinsic value, he would examine the company's balance sheet, income statement, and cash flow statement, estimate future earnings, discount them at a conservative rate, and arrive at a figure that would serve as a benchmark. In modern terms, you could use discounted cash flow analysis, or a simplified EVA, economic value added estimate. The third pillar is the disciplined investment process. Graham insisted on a systematic approach that begins with screening for low valuations, followed by rigorous due diligence, and ends with a psychological commitment to buy or hold rather than chase fads. He wrote, "The real skill in investing is not in predicting the market, but in evaluating securities based on sound principles." The fourth pillar is earnings quality. Graham warned against companies whose earnings were inflated by one-time events or aggressive accounting. He would analyze footnotes for hidden costs or contingent liabilities. In a contemporary scenario, you would scrutinize the sustainability of earnings by reviewing a company's operational metrics, debt coverage ratios, and profit margin variability over several years. Finally, the fifth pillar is patience. Graham's most famous admonition is that time in the market beats timing the market. He emphasized that investing is a marathon, not a sprint, and that discipline over years would compound into significant wealth. A practical way to incorporate these 5 pillars today involves creating a set of screening criteria: price to earnings, price to book, debt to equity, and free cash flow coverage, and maintaining a conservative valuation model with a built-in safety buffer. Key takeaway: Graham's 5 pillars provide a blueprint that remains fully applicable in today's technology-driven markets. By systematically applying margin of safety, intrinsic value, discipline, earnings quality, and patience, you can reduce emotional decision-making and preserve long-term gains. Which of these 5 pillars do you feel will most change your current investment practices? From theory to practice, Graham's legacy in action. Benjamin Graham was not just a thinker. He was a practitioner who translated theory into tangible value. As an analyst for the Graham-Newman Partnership, he spent hours poring over financial statements, dissecting balance sheets, and projecting cash flows. He had a habit of writing down numbers in his notebook and revisiting them, a method that taught him to treat every investment as a case study. Graham's approach was so rigorous that his students, most notably Warren Buffett, praised him for the clarity of his process. He once remarked, "Investing is most rewarding when it is a disciplined exercise." This sentiment guided his teaching at Columbia University, where he emphasized that sound judgment depends on a well-structured analysis framework rather than gut instinct. On a personal level, Graham's practice of setting a stop-loss for securities he had purchased is a lesson for all investors. He would monitor his portfolio, and if the price of a stock fell below a predetermined threshold relative to its intrinsic value, he would sell, even if he still admired the company. This discipline prevented him from being swayed by market sentiment and reinforced the importance of sticking to objective criteria. To apply Graham's methodology today, start with a deep dive into a company's annual report. Look at the management's discussion of cash flows, note any changes in revenue streams, and calculate key ratios like operating margin and return on equity. Then discount the projected cash flows back to present value. If the current market price is below this estimate by a comfortable margin, consider it a worthwhile purchase. Key takeaway: Graham's practical work reminds us that great ideas must be paired with analytical rigor. Whether you study a quarterly report or create a personal budget, treat each decision as a problem to solve with data, not emotion. How might you integrate a disciplined, data-driven review process into your daily financial decisions? Applying Graham, Modern Playbook for Value. If you are reading this with the intention of applying Graham's wisdom in contemporary life, the following steps may help translate theory into practice. First, build a personal valuation model. Write down your monthly income, essential expenses, discretionary spending, and savings. Treat each expense category as a security and evaluate whether it offers a sufficient return relative to the risk of unnecessary spending. If a category's cost outweighs its benefit, much like an overvalued stock, consider cutting or reallocating it. Second, develop a safety cushion in your savings. Graham would say that the margin of safety in investing parallels the cushion in one's personal life. Ensure that you have at least 8 to 12 months of living expenses in a low-risk account, so you do not have to liquidate investments during market downturns. Third, use a margin of safety approach to purchases. Before buying something major, a car, a home, or a piece of equipment, research the market price and compare it to the intrinsic value you determine as a consumer. For example, if a used car's depreciation rate is known, discount its future utility and compare that to market price. If the price is higher than your calculated safe level, postpone the purchase or negotiate. Fourth, practice patience and hold in your investment portfolio. Use a set of clear guidelines. Buy when a stock trades at a price below 80% of its intrinsic value, never reevaluate on a daily basis, and wait 5 to 10 years or until the company's fundamentals deteriorate before selling. This reduces emotional trading and allows compounding to work its magic. And finally, document everything. Keep a journal of every investment, reasoning, and outcome. Graham was known for his meticulous note-taking. It helped him avoid repetition of mistakes and refine his methods. A simple spreadsheet can record purchase dates, purchase prices, intrinsic values, and eventual returns. When the market reverts to its mean, you will recognize that your disciplined process has stayed intact. Key takeaway: by treating your personal finances and your investment portfolio with the same disciplined, margin of safety mindset that guided Benjamin Graham, you can achieve stable growth, avoid unnecessary risk, and remain focused on long-term goals. What step will you take today to incorporate a margin of safety into an upcoming personal or investment decision? Your journey SDRTS now. Embrace Graham's legacy. Benjamin Graham's legacy lives on through the principles of disciplined valuation, rigorous analysis, and the protective cushion of margin of safety. Whether you learn from a historical biography or apply his teachings to digital platforms, the core idea remains the same. Value your decisions, protect your risk, and trust the process. By closing this series of chapters, I invite you to reflect on how much of the narrative above aligns with your current mindset. Perhaps you have already practiced patience or calculated intrinsic value. Perhaps you're starting to use a safety cushion in your savings. No matter where you stand, the timeless wisdom of Benjamin Graham offers a roadmap for those who value prudence and principle over hype. If you found these insights helpful, please consider liking this video to acknowledge the effort invested in distilling these lessons, sharing it with friends who may benefit from a more disciplined approach to investing, and subscribing so that you can stay updated on future explorations of influential thinkers who shape our world. Thank you for joining this journey of learning. What will you do first to honor the principles of Benjamin Graham in your life?